contrary to what you read in the New York Times, corporate America is not underinvesting. It's investing hugely in its future, but it's not in plant and equipment. It's in brand building, promotional, employee training, business building. Intangible assets of all kinds are what explains the remarkable increase in stock prices. And this is where Amazon gets its value. Amazon is a company that produces huge amounts of value with minimal amounts of reported earnings. Earnings have become largely irrelevant. That's the big lesson of modern corporate finance. Earnings don't matter. That was the mantra of our Stern Stewart company. Earnings per share don't matter and dividends don't count.
My name is Michael Guyette, publisher of the Lead Lag Report. Joining me here is Mr. Don Chu. Don, you and I were briefly chatting. We're going to talk some big picture stuff as far as why the U.S. has done as well as it has and why it might continue to do so, or maybe not. But introduce yourself to me, the audience. Who are you? What's your background? What have you done throughout your career? And what are you doing currently?
Hi, name is Don Chu. Thanks, Michael, for having me, first of all. Name is Don Chu. My job has been to edit the Journal of Applied Corporate Finance, an obscure publication that it aims to take outstanding academic work in corporate finance and bring it to practitioners. Morgan Stanley bought and owned the publication for about 10 years where I worked there, and they used to send it out to about 15,000 investment bankers. I was the founding partner of a company called Stern Stewart in 1982. We brought the principles of corporate finance to our practicing corporations. We invented a measure of performance called EVA, or economic value added. That's enough for now, I think. So I have this new book in which I say that American style corporate finance is one of the world's great success stories of the past 45 years. And it's right up there with advances in information technology and medical technology, advances that it helped make happen.
When you say corporate finance, let's talk to the lowest common denominator for the audience. Meaning,
Okay.
what is it about corporate finance in the U.S. which makes it evolutionary over time?
Well, first of all, let me define corporate finance.
Yeah.
When I joined Morgan Stanley, I was asked by my boss, we had a meeting with the CEO. She said, on a sheet of paper, write down a definition of corporate finance in 4 bullet points. So I said, okay, it's the investment decision. What business are we in? What kind of investments do we have to make and how do we value them? The second subject is financing. Do we fund ourselves with debt or equity? And do we pay out our capital through dividends or stock repurchases? The third topic is enterprise risk management. What risks are we in business to take? What businesses do we lay off to others using derivatives or whatever means? The fourth subject that I view as a main part of corporate finance is internal corporate governance. What's our organizational structure? Who reports to whom? How do we evaluate their performance? How do we reward people? And then how do we talk to investors about our policies and what we're doing? Now, the thesis of my book is that America has gotten this field better than the main academics and scholars were mostly American, and the practitioners have been American. And what they have done is found ways to just create value. And what I mean by create value is not producing steady increases in earnings per share, but earning high rates of return on capital and lots of them. So every company has a cost of capital. That's the minimum required rate of return. So your job as a corporation is to earn rates of return higher than the cost of capital and to spend lots of money doing that. But at the same time, you have to cut back on all those investments that are failing to earn the cost of capital. And this, I argue, is what America does better than anybody else. It cuts back investments that are failing, and this provides the growth capital that funds our world-leading growth industries, our venture capital. The power to fire is the power to hire. The power to cut investment and shut down failing companies provides the secret sauce for our world-leading growth industries. I'll stop there.
Let's expand on that a little. I'm with you. Where my mind goes to this is if you're going to be a good steward from a corporate finance perspective, you've got to have some degree of confidence in around the future, right? I mean, if you're going to do a weighted average cost of capital and MPV type calculations, you have to assume that there's some visibility as far as where rates are and hurdles and things like that. How does that change when you're in a volatile interest rate environment or an environment like we're seeing from a policy perspective now with the Trump administration?
I started writing this book about 3 or 4 years ago, and every macroeconomist and business forecaster was saying we were going to have a recession. How did they know we were going to have a recession? Well, they knew that we were having inflation. We knew the Fed was going to raise interest rates. We didn't know they were going to raise them 500 basis points. But macroeconomists all look back to the 1970s because that's our last bout of stagflation. That's the last data point they have in their model. Well, the revelation, the insight that occurred to me, and that's at the heart of my book, is that today's companies are nothing like the companies of the 1970s. Today's companies are lean and mean, ready to cut, ready to respond to any exigency. And one reason they are is because we have activist shareholders breathing down their necks. We had a tech recession 3 years ago in which companies like Elliott Management went after America's most valuable companies and said, look, you guys need to lay off 10% of your workforce. You need to stop doing bad acquisitions. And this has ensured that our companies have not become the bloated conglomerates they became during the 70s. So again, our companies are ready to deal with almost anything, even what Donald Trump can throw at them.
Why has that not been the case when it comes to other developed nations, different parts of Europe? What is it about the U.S. that makes it different?
Well, in Japan and Germany, investors have virtually no control. The companies are basically run by managers, and the corporate policies are based on full employment. And so a manager and investors have until fairly recently have not been allowed to intervene in that process. Germany, for example, its largest company, Volkswagen, has never had a plant closing for 100 years. They have a system called co-determination where employees basically get one vote for every shareholder. So the companies in Germany are basically run more for employees than for investors. And predictably, there is no burgeoning stock market where a private investor can put his or her money. So America, to a far greater extent than any other country, although the Commonwealth countries don't sort of follow behind, empower investors to step in and correct companies when they've gotten off track. In Japan, you can't do that. You can't do it in China. You can't do it. You can do a little bit of it in continental Europe, but you may have missed this, but the Financial Times ran a piece about Japan at the beginning of this year, and the spokesman for the Kaidan Ren, which is the Japanese Business Roundtable, basically said, look, folks, we've been in a recession for 30 years, and we are now inviting American shareholder activists like Elliott Management and KKR to come over and reform our companies. Our companies have been failing. They're inefficient. We want American activist investors to come over and basically restore financial discipline to our companies. So we do that better than anybody else.
You think it's is there something unique culturally about the U.S. versus others that does that? Is it more about the legal framework? I mean, where does that come
It
from?
has a lot to do with the legal framework. There's the most cited paper in corporate finance is by Schleifer Vishny, and I forgot the other, but it's about the common law legal system, which basically empowers property rights above other rights, the civil law systems that dominate. So that you could view that as the legal origins. But in America, we carry things farther than anyone else. So our system has basically, even to a greater extent than England and Canada and Australia, we encourage investors to step in and make their voices heard, and we amass capital in that fashion. So again, by cutting capital out of companies that are failing, we create the capital that can then produce these great value building growth companies that we now have.
How much of that is maybe just driven also by technology dominance by the U.S. compared to other? For me, a lot of the efficiencies, a lot of the dynamics around forecasting also do come down to not just good data, but the tools used to manipulate that data.
Well, the technology is really, it's partly an output of the capital. In other words, the money, the relationship between finance and technology is a symbiotic one. I view finance as the handmaiden to technology. Finance takes out bad technologies, and by depressing their prices, takes that money and then identifies the new technologies. And that's what all these companies are doing in AI today. We have no idea what they're spending it on, but we just say we let them spend hundreds, billions of dollars on AI because it looks good. And one of the most interesting phenomena I've seen is, let me ask you a question. You're a CFA. There are two variables that explain stock price increases over the last 50 years. In 1970, it was earnings. Earnings used to be 50% a correlation between 5-year movements in earnings and prices. There have been two variables that explain virtually all of the correlation between stock prices and these two variables over the last 50 years, to the point where earnings doesn't explain anything anymore. Earnings has zero relevance. These two variables are the ones that are the secret sauce. I'll give you 10 seconds, and then your Jeopardy question is.
Yeah, well, I mean, my mind immediately goes to money supply, liquidity, obviously, and then which has been a big driver more recently for PE expansion. Um, on the other one, I don't know. I mean, it seems like that's what's driving at least the most recent market movement is more just straight up dollars.
Okay. Well, now I'm going to have to correct you.
Please.
Money supply is a macro variable, and my book says macro doesn't matter. Macro statistics are almost worthless. GDP is pretty much worthless. GEP productivity stats there's really not much there. What the variables of interest are the increase in R&D and the increase in SG&A, selling general administrative expense. That includes all the corporate investment in intangibles. It's brand building, promotions, employee training, everything valuable that gets expensed is in SG&A. SG&A has gone from 20% of assets to 55% of corporate assets in the last 50 years. And as I said, the correlation, if you want one variable that's correlated with stock price movements, it's corporate spending on SG&A and R&D. So what this says is, we really don't know what this money has been spent on, but we trust in the companies to spend it wisely and well. And that is what the past 50 years have shown. Contrary to what you read in the New York Times, corporate America is not underinvesting. It's investing hugely in its future, but it's not in plant and equipment. It's in brand building, promotional, employee training, business building. Intangible assets of all kinds are what explains the remarkable increase in stock prices. And this is where Amazon gets its value. Amazon is a company that produces huge amounts of value with minimal amounts of reported earnings. Earnings have become largely irrelevant. That's the big lesson of modern corporate finance. Earnings don't matter. That was the mantra of our Stern Stewart company. Earnings per share don't matter and dividends don't count. So I'll stop with that.
That sounds like a scary world if earnings don't matter. Kind of throws everything out the window as far as what we're talking investing.
Well, they need not matter. Let me correct myself. Earnings per share matters for the mature sector. If you're making Twinkies, sure, you gotta produce earnings. But once you produce anything that has anything to do with high technology, all the bets are out the window. What you're looking for is, what's the margin on the next dollar of investment? Is it 80 or 90%? And how much capital do you need to put yourself in a position where you can earn those kinds of margins? So in that sense, earnings per share don't matter. And Amazon has basically showed that. Amazon basically says in its 1997 shareholder credo, if you care about earnings, don't buy our stock. You won't like us because we're about building long-term value, investing in our employees. We're not about earnings per share.
I mean, it sounds to me then that valuations don't matter then from that perspective.
The valuations matter. They just don't have anything to do with earnings. You have to project the margins. You have to project the capital flow, the capital needed to do that. You just have to change. You just have to get earnings is just the starting point. That's point A. From there, you have to build your own estimates of what is normal recurring earnings. What is the cost of capital? What multiple do you need to assign to all this remarkable investments that are none of which are going to show up on your balance sheet?
See, a question from why are we then seeing a greater outflow than in the recent past out of the U.S. Is simply a hedge against the dollar versus corporations. So this kind of goes a little bit to the money flow aspect, because these are dynamics you're talking about that are very long in nature. This is more short term, but how do you think about sort of international flows in the context?
Well, I think so. Some people are scared of Donald Trump and they're scared of his tariffs and they're scared of his craziness. My view is that American institutions everything that supports finance are stronger than Donald Trump. They're stronger than Joe Biden, and they are the reason for 45 years of a remarkable outperformance by the U.S. stock market. I mean, it's a productivity miracle. Again, even though it doesn't show up in the productivity statistics, it shows up in stock prices.
Is there anything to looking at corporate finance efficiency, everything we've talked about? Is there anything that suggests that it's different or maybe less powerful when it comes to different sectors of the economy, of the stock market?
Well, my book argues that private equity has outperformed public equity for 45 years. And Michael Jensen said he wrote The Eclipse of the Public Corporations, which was, maybe Harvard Business Review's most famous article. But what he said was that mature companies no longer should be run as public companies. Once you lose your growth, your mojo, then you're probably better off run as a private company where, that's you got to, and debt actually, facilitates that. But if you're in the growth sector, then you're going to manage very differently. You're not going to use debt at all. You're going to use equity, and you're going to value yourself. You're going to project all these investments and try to invest as much money as possible in these future growth creating opportunities. That's a partial answer to your question, but it's really the difference between growth and value. And increasingly, the U.S. has been showing that private equity runs value better than most public companies do. I mean, once you get into the really mature parts of value, private equity is the way to go because you don't need lots of new equity capital. Whereas, public equity is great for funding companies with clearly profitable growth opportunities like the Magnificent Seven.
I actually don't know the answer to this. I'm just curious more for myself. But since you mentioned private equity, are there any studies that suggest that survivorship bias is more of an issue when it comes to public equity versus private equities?
I'm sorry, I can't help you with that one.
Yeah, no, I'm just curious. Because I wonder if that person.
I mean, what's the thesis?
I think if survivorship bias is higher for private equity, then it would make the private equity returns look in aggregate like it's larger than for public equities.
The way they measure the returns is they actually look at every distribution by to a limited partner. So I just don't see, I can't see the survivorship coming. I just haven't thought about this enough. But I mean, one thing we've learned about private equity returns is that when you look at the actual pattern of payouts, private equity is actually less risky than public equity. I mean, most people say, oh, well, private equity is leveraged, way more leverage and way smaller. So it's got to be at least 25% riskier than public equity. Well, if you look at the actual payouts to limited partners, private equity turns out to be less risky than public equity. Just, private equity finds ways to manage business and financial risks that just public equity has not figured out how to do yet. They're just not that good at managing that kind of a company.
You've hit on productivity a few times. Let's pivot this a little bit towards the labor side of the equation.
Yeah.
I think this is where it gets to be interesting, especially if we're moving in general towards deglobalization and the pendulum swing back towards domestic from international in terms of where labor is hired primarily. Explain to me, why is it that U.S. labor has such an advantage over other types of labor?
You mean why their payoffs, why they benefit?
Yeah, and why the productivity is so much higher.
Well, the productivity is a function of the management, and the investors leaning in. When, you take some of these tech companies, they were clearly over hiring, and until approached by activist investors, they continued to overhire. So if Google, for example, hired Ruth Porat to be its CFO in the middle. It was in the middle of this diversification and expansion binge. And so they actually hired Morgan Stanley CFO Ruth Porat to restore a measure of discipline. So that will end up increasing the productivity of your workforce just by getting the right amount of capital. I'm not I'm not a labor engineering expert. I don't know the different techniques of improving labor productivity, but I know that the managerial focus is really it's on managing capital efficiently. So what you really want to know is it's total factor productivity. How well do you manage your combination of capital and labor together? And one of the other things we know, and by the way, labor benefits from productivity. There have been all kinds of McKinsey studies of US labor productivity starting from World War II on. And they show that the US has an advantage in labor productivity. And they also show that hiring takes place when companies become more productive. That when the totality of American companies are more productive, the total workforce gets higher and the wages end up rising along with those increases. In fact, there's never been a 10-year period in which productivity has risen and labor has not. And in the few periods where productivity has actually declined, the workforce has also declined as well. So labor really depends on the productivity of companies. They cannot really prosper unless companies become more productive. So
I think when a lot of people hear about corporate finance, when it comes to the public markets, their mind might go immediately to financial engineering, which has been one of the arguments for why equities had done so well for the last 15 years or so. And a lot of kind of financial engineering in terms of the balance sheet. Is there any credence to that? That maybe the corporate finance premium is more because of the creativity around what can be done on the public equity side?
actually, I think the creativity is on the private side. In terms of financial engineering, it's private companies that use debt. Public companies, if anything, make too little use of debt. They're just not comfortable using debt. So I don't understand the argument. Sorry. They, uh, um, and private equity itself, the financial engineer, when you write a history of private equity, it was all about financial engineering in the 1980s. In other words, you could buy a company and lever it 9 to 1 and give managers a lot of stock, and you got miraculous changes in efficiency because these are companies that were bloated and needed to shrink. But the history of private equity is one in which they have gradually been forced to acquire operating skills and expertise. One firm, TPFG in Chicago, I have the name wrong. They actually hire the retired CEOs, put them in a stable, and then go out and find them a company to manage. So what private equity is saying is that managerial skill is the scarce commodity. And private equity CEOs, by the way, the most successful ones get paid a lot more than the best public company CEOs. If you want to get paid for what you do, if you are a successful CEO, you want to be in private equity, not public equity, where everybody gets to see how much and complain about how much you make.
I'm looking at the description of your book, and the first sentence I'm seeing here is, why did the stagflation of the 1970s, the improbable combination of high unemployment and runaway inflation, prove so painful? How does stagflation that factor into anything we're talking about here?
It explains the 70s in the sense that as I said, the companies were all so bloated and conglomerated. They were in so many different business lines that when they suddenly encountered 10% interest rates, and they were just incapable of responding to it. And so they ended up, they lost half their value in the 1970s, and then as Michael Jensen said, what we know about takeovers says that companies could destroy half their value before outside investors were able and willing to intervene and correct the process. The companies in the 70s allowed themselves to become these bloated conglomerates. They were facing no pressure, and then suddenly they were faced with double-digit inflation, and they didn't, they had no way to respond to it. Whereas our companies today, they know what to do. They're already, every company is thinking about, okay, what do I do if these tariffs get slapped on me? What if they were saying 3 years ago, what if interest rates go up 400 basis points? What is our game plan to respond to that? It was only the federal government, the Federal Reserve Bank did not even contemplate an increase in interest rates in its own scenario planning. So yeah, the Fed doesn't know what it's doing, but our companies do.
That's an interesting take because that would suggest that the concerns around maybe stagflation, which have been kind of popping
Sure.
throughout there, right?
As they were 3 years ago,
Right,
everybody
exactly
was
right.
talking about how are our companies going to deal with all these interest rate hikes? We're going to have a recession. And we didn't. There was no recession and no macroeconomist could explain it. Paul Krugman, Tyler Cowen, they were saying, what happened? What's wrong with our profession? We seem to have lost our crystal ball has clouded over. Why can't we explain, how our companies are going to respond to, and my book argues because they don't have a theory of corporate finance.
I think they're gonna have to buy that book then.
I hope so.
So, okay, let's talk about going back to the international side. I mean, is there anything that Japan, that other countries can do to close the gap with the U.S.? I mean, what's needed to get a little bit more?
Well, in I have a chapter on China, and I say the first thing China needs to do is privatize their state-owned enterprises. And I was at a conference in 2014, and there was a shareholder activist there named David Webb, and he said, "Look, China today is in the same condition that the UK was in 1980. It was just full of state-owned enterprises, and Margaret Thatcher made the decision to privatize most of these, large publicly run companies. Well, China really needs to do the same thing, and they need to invite foreigners to come in and take positions and help run their companies. China is not intent on doing that, but these countries need to get the attention of American shareholders and make them, they're capable of becoming partners in the enterprise. So you want to invite American and other foreign activist investors to become partners in your enterprise. I did an entire issue of my journal on Germany, probably about 10 years ago, and they were weighing the same sets of issues. Do we invite investors to become partners? What do we do about co-determination? The idea that employees get half the board seats. Does that make sense going forward? So that they just need to think about building their capital markets so that their own people actually want to hold shares in their companies. Outside of the Commonwealth, there are very few countries where savers would actually entrust their money to publicly traded companies. The German stock market has almost no credibility with its own citizenry, and to me that's a source of impoverishment. That's the history of Japan for 30 years. Japanese people don't trust the stock market. Why would they put their money in a Japanese company? They'll never get it out.
Talk to me about why you wanted to write the book. I mean, it's quite an endeavor to do that.
Well, when you've been doing something for 45 years like me, and you get so little respect from from one's own children, you have to try to make some kind of statement about the usefulness of how you've been, what you've been doing with your time all those years. I just feel, the subject of corporate finance is just completely misunderstood. It's totally off the radar, and no microeconomists really. It's viewed as the ugly stepchild of the true economists are the macroeconomists. They think the world is run by central bankers and our prosperity depends on central bankers. Well, no, I'm saying it ain't so. Our prosperity is micro based. It's what companies do, the people who work for them, and how you run those companies and how productive those companies are. And so we got to find a way to measure. We got to find a way to measure the productivity better because I know we've been seeing productivity. It's in the stock prices, but it's not in the GDP statistics. So
The, talk to me about sort of the research process. I mean, obviously, you've been at this for a long time, but when you're putting pen to paper or fingers to keyboards, you have to do quite a bit of additional research and probably found things which you hadn't thought of or were aware of. Talk to me about the process of research that went into the book.
well, no, it was more a matter of recollection, and I knew all these people. Every chapter is told that I identified four core subjects in finance, and each one constitutes a chapter. And then when I write the chapter, it's not me talking; it's my expert. I choose some academic expert that I knew well, whose work I published. I probably published 15 articles by each of these people. So I recount their own journey. What is it I started out by knowing, and what did I want to learn, and what did I find out about corporate risk management or about private equity or Chinese corporate governance? And then I say, and how, yeah, and what is the social what are the social consequences of this subject being treated well and our companies being made to run better? And my last and my the research mission that I now have in mind, and then I talk about this with a guy named Shiva Rajgopal, who's the chairman of the Columbia University's accounting department. I say, Shiva, we all know that earnings really is irrelevant. Our earnings has lost its statistical relevance, but we also suspect that macro statistics have lost their relevance, and pretty much for the same reason, because all the macro stats, GDP is just a record of transactions. How much was something sold? But there's nothing about the consumer surplus, the value of the products that were sold, how much more valuable they might be, how much people would be willing to pay for them. And if I could do one more research project, it would be something like, how can we make macro statistics, better reflect the reality of the wealth of nations, and using the insights that we get from where accounting has gone wrong. Corporate finance is finding all kinds of ways outside of accounting for companies to communicate their value propositions. Well, how do we do this for macro statistics as well, using some of the same principles and insights?
Don, for those who want to check the book, read the book, and maybe track more of your own thoughts, where would you point them to?
Well, I've been producing this Journal of Applied Corporate Finance with Wiley for 45 years, but this is the end. So I imagine Wiley will still post some of this stuff, but I'm starting with a couple of guys, a new media company whose main job is going to be to repackage a lot of old JSF articles and insights, basically cutting stuff down in smaller, more digestible bits. But I'm not at liberty right now to reveal the details of this. So some version of the Journal of Applied Corporate Finance will exist going forward, but it will not look like the Journal of Applied Corporate Finance of the past. But anyone who wants to talk to me, I'm happy to chat.
Appreciate those that watch this, and please do me a favor and check out Don Chu's book. Thank you, Don. Appreciate it.
Thank you very much, Michael. Very much enjoyed it.
Cheers, everybody.